Hello, my name is Livio. If you own a discount brokerage account, have a 401k plan, superannuation, or other retirement plan anywhere in the world, then this information is for you, and it can cut your time to retirement substantially. If you own mutual funds, stocks, gold, silver, currency, or real estate, then you are in the right place at the right time. Whether you are a complete novice investor, have little money, or have experience, or are an investment professional, this short video is going to teach you how to change your financial destiny for the better. Do you know there's a proven way to make money while the markets are going up? Yes. And there's a way to make it 50%, 100%, or 200% or faster, and do it without risky options or futures contracts. That's right. Would you like to know a proven way to avoid the majority of market declines or even make money while they decline? Nope. You don't need risky options or future contract for this either. That's right. Let's get right into it so that you could take a deep breath, relax, and not worry ever again what the markets are doing or are going to do. You'll have complete control and peace of mind knowing your family's well-being is protected from the insecurity and devastation of substantial stock market losses. So let's start right now. Let's go.
At Interanalyst, our track record proves this. The stock market's direction does not matter. What you own during that direction does matter. Lower your fund fees, build profits while markets rise, preserve those profits while markets decline, and retire up to 21 years sooner. The S&P 500 index is the benchmark for the overall U.S. stock market. The index has outperformed 96% of all mutual funds in every rolling 10-year period since 1950. The S&P index is available in all corporate retirement plans and discount brokers. Let me tell you some inside information right now. This is the insider's investment tool of choice when markets rise. Just listen to Jason Zweig.
And one of the ultimate dirty secrets of the fund industry is that a lot of people who run other fund companies own index funds in their own accounts and don't talk about it unless you put a couple beers in them.
But do these insiders avoid stock market declines? And can you? The answer is yes, and I'm going to show you how it's done. Here's how it's done. Financial analysts use the S&P 500 in what is called correlation analysis. Correlation measures how investments move in relation to each other. -1 means investments move in opposite direction. As you can see there, one's going up and the other's going down. +1 means investments move in similar direction. As you can see, the two are going up and the two are going down. High positive or high negative correlation is the key to limiting risk and increasing return in both bull and bear markets. Okay, so let's learn about positive correlation. We use the S&P 500, as everybody does in the industry, to visually show you correlation. The bold black line in the 2008 chart below is the S&P 500 index. The other colors represent the Dow Jones Industrial Average, the Russell 2000, and the NASDAQ index. As you can see during the crash, all of them went down in lockstep with the S&P 500. This needs to bring up something to your mind real quick and ask yourself, well, if they all go down, what does diversification mean? You see, it's not just about diversification because as you can see here, diversification, they all went down. So it's not just about diversification. It is about correlation, and we're getting there slowly as we go forward. Okay, now that we're done looking at a bear market, let's look at the bull market that you see in the chart here. That's since 2009. What does this positive correlation imply? It implies that large cap, mid cap, small cap, international, and technology indexes all move in lockstep with the S&P 500 direction and have a correlation of close to +1. Okay? You can see the little box there with the symbols in it. The first one is SPY. The second one is the Dow Jones Industrial Average, DIA. The third one is the Russell 2000, the IWM. And the QQQ represents the NASDAQ. If you take a look at those, they are all above 90%. What does this imply? It implies, as the two charts illustrate, that the markets go the same direction, or these indexes go the same direction as the S&P 500. Okay? So if there's going to be a bull market, they'll follow. If there's going to be a bear market, they're going to follow the S&P 500. Okay? That's what this implies. Now let's take a look at negative correlation. The chart below implies that SH has a correlation of close to -1, because as the S&P 500 moves, SH will move in lockstep in the opposite direction. This is better known as an inverse fund, because as you can see in the chart, it grows when the S&P 500 crashes. Okay, you now understand, okay, that there is positive correlation and negative correlation, okay? What we're going to do is teach you right now the wealth preserver and the arrows that provide the direction of the market, okay? And then when we come back from that, we'll show you how to profit from both positive and negative correlation. Now that you understand how correlation works, let's take a look at the wealth preserver subscription. Each colored bar represents a month. You must log in after 10 p.m. the last trading day of each week to see if there is an arrow. Arrows may appear weekly, allowing you better market entry points. However, arrows are only confirmed and locked in the last trading day of each month. When you see a green up arrow, like this one, buy and continue to buy within your brokerage or retirement plan account until you see a red arrow appear. When a red arrow does appear, it indicates to sell your investments and avoid much of a serious decline in your retirement account. When you do sell under the red arrow, your money will automatically settle into a money market account within your retirement plan or discount brokerage account. Note, not every arrow is perfect, but wouldn't you rather be safe than sorry, like most people in 2008? Because the red arrow locks in the high growth you captured under the prior green arrow. Then all you do is wait for the next green arrow. That's all there is to it. Green arrows mean invest, red arrows mean preserve and protect. Now that you know how the wealth preserver works, I want you to know that this scrolling chart is real. The arrows are filed quarterly to certify, authenticate, and validate all green and red arrows. I'll be back shortly. Okay, now that you see how accurate and how great these arrows are, you can learn now how to make your money grow faster in bull markets. And it's done through correlation. If you look at the little chart there with the SPY, the RYNVX, and the RYTNX, it represents three securities that are based on the growth of the S&P 500. The SPY obviously is 1-to-1. The RYNVX is the RIDEX Nova Fund, and it grows 150% faster than the S&P 500. Then there's the RYTNX, okay? That fund grows at 2 times that growth of the S&P 500. If you know at a better than 90% clip that your correlation is going to take those assets up, why grow at 1-to-1 when you can grow at 1.5-to-1 or 2-to-1? Does that make sense? Now you see how correlation works. Well, let's take a look at the growth chart, okay? As you can see, since 2009, okay, in the black, you can see that the market grew 128%. Now, If you use the RYNVX at 150% growth rate, you would have grown at 257%, okay? With the same exact movement of the S&P 500, all right? Now, let's take a look at the 200% growth rate, the RYTNX. Instead of getting 128 or 257% growth, you got 358% growth, all in the same time frame. So now you can see how you could put correlation in your pocket, in your retirement account, and get to retirement way faster. Now, let's talk about bear markets, okay, and the risk associated. Here's a question you can answer. Is it lower risk to lose money when the market declines with buy and hold, or to preserve your money by exiting and sitting on the sideline? You can see in the chart here, had you got out with our arrow, you'd have been sitting up here with 0% growth. If you'd have held on, you'd have ended up negative 40, 50%. That's in 2008, and look at the correlation. So you can see that diversification wouldn't have helped you. The only type of thing that would have helped you is getting out, okay? Since you know that if you lose 50%, it takes 100% just to get back to even. I think just watching this will give you an indication of why avoiding losses is so important.
It was like, holy smokes, how do you stop the bleeding?
The reality of what you've lost is huge. Now half of your 401k is gone.
You know, if it took 13 years to accumulate $80,000 and 1 year to lose half of that, and then try to get that back in another 13 years and only be at the $80,000 that you were 13 years ago, the math doesn't work.
You saw their faces. They're absolutely devastated and have no answers. But there is an answer. When we show a red arrow, go to the sidelines and wait it out. We are going to have fun here on this slide. I want you to think very closely and stay focused on this because this is just stunning. Is it lower risk to lose money while the markets decline with buy and hold, or to make money because of very high negative correlation? You can make money while everyone else loses. Let me show you. This little box here shows you the SPY, which again is the S&P, as you know. And then it shows you SH. SH is an ETF that is the inverse ETF of the S&P 500. Now I want you to understand, this is not a high-risk options or puts. It's not leveraged or anything like that. It simply works like a regular mutual fund. The only difference is instead of making $1 while the market goes up, it makes $1 while the market goes down, okay? So let's look at the chart. As you can see here, if you'd have had $100 at the beginning, at the end, you would have had $50 if you just bought and held. Or had you bought the short SH, okay, which is the ETF, you'd have ended up with $174. So while you have $174, your friends have $50. Amazing. So in other words, not only like in the previous slide where you can make money while the market's going up at either 100, 150, or 200% going up, you can also make money when it's going down. This gets you to retirement so much faster, it's stunning. The Wealth Preserver works in 401k, IRA, superannuations, and other retirement plans around the world, okay? Here's how it works for those. Since you've learned that correlation analysis proves that better than 90% chance that the assets within your retirement plan are going to go up and down with the S&P 500, why in the world, when we get a red arrow, would you want to be in that and in those assets within your retirement plan and see them lose up to 50% or even more with the coming crash? Makes no sense, okay? Just sit on the sideline, contact your plan administrator, and request that they just put it into a money market account or the safest government bond fund and sit on the sideline while that declines. Then get back in, as we showed you just a few minutes ago in those charts. Now, for those of you who do own discount brokerage accounts, or if you don't have one, I suggest setting one up, okay? The nice thing about the discount brokerage account is that within that account, you can get the SH fund, okay? You can also get those 150 and 200% leveraged assets going up. So you can really put your retirement into hyperdrive. With retirement plans, you can avoid the declines and grow at a normal pace. With the discount brokerage accounts, you can grow at a much, much faster pace, okay? Because you can make money when the market goes up and you can make money when the market goes down. Those short funds are not available in retirement plans, okay? So at least you don't lose 50% in the retirement plan. You can at least preserve that and grow at normal market rates on the way up. You're still miles ahead of those people who don't avoid bear markets, okay? That is how the Wealth Preserver can help you. We'll take a look at some Wealth Preserver charts in just a few minutes, but we're going to now move on to the Wealth Maximizer. The Maximizer works in tandem with your Wealth Preserver and can really accelerate your growth through its powerful search engine. Let's take a look. Welcome to the Wealth Maximizer. The Wealth Maximizer is designed to be used in tandem with the Wealth Preserver. Now, I'm going to explain this product to you. It's going to be in two parts. One is for those people who have retirement accounts at companies like who might have Vanguard or Fidelity or something like that within that retirement plan. The other is for those who have discount brokerage accounts. I'm going to tell you, by the time you're done with this, you're probably going to want to open a discount brokerage account, okay? So pay attention here. Now, the Wealth Maximizer is designed around three filters. The first is the correlation filter, as you see here, okay? And essentially what that means is that you can search over 300,000 securities available, okay, by correlation. So you know, since you already have seen and understand the Wealth Preserver and the arrows are based on that correlation, you can find securities that are very, very highly correlated and see how they perform using our signals. This gives that information. What about the performance filter? What if all you wanted to do was look up the highest performing securities? Okay, and once you do that, you can go in search of which ones are highest correlated to the S&P. You can do that as well. And the third one is more of a filter that doesn't allow you to see securities. And let me explain why. The reason it doesn't allow you to see securities is because we don't allow those securities to come through because they haven't existed long enough or they're kind of questionable. So we eliminate them from this list. First thing I want you to do is understand how we do the correlation. So all you do is come down to sort criteria 1 and you hit correlation, okay? And you hit submit. And what it does is it ranks them by correlation. I'm not allowing you to see any of the names or the symbols because I'm just trying to give this as an illustration. As you can see here, this one ranks at 99.91% correlated with the S&P. You pretty much know that this is going to go up and down with the market. If you'd have bought and held this security, okay, without using the signals of the Interanalyst, you're going to get 3.11% in buy and hold. Now, if you use the Interanalyst signals, you'd have gotten 9.22%. If you'd have done this, you'd have done 200% a year more return since 2000. That's just huge. Now, for those of you who have retirement plans like a 401k or a superannuation, whatever it is, you can go in here and you can limit by the name filter. Let's just say that you have Vanguard. Vanguard is available in your retirement plan. So you just put in the name Vanguard, bang, and here you have all the Vanguard funds listed. Again, I'm not showing you the names, but they're all listed. All funds that Vanguard has are also available in 401k plans. Let's just assume that you have one of these Vanguard funds in your retirement plan, and you'd have bought and held that fund, you'd have gotten 4.5093. If you'd have used our signals to get out and avoid those market declines, you'd have gotten better than 100% more return. You'd have averaged 10% a year since 2000. So you can see how powerful this is in your retirement plan. Some people don't have Vanguard, they might have Fidelity. So you just type in Fidelity. And here we go again. Now here's a list, okay? And you can rank these by by correlation, but as you can see here, they're all highly, highly correlated. So why would you want to sit in your retirement account and watch your money go down in that retirement account when we have a red arrow signal in the wealth preserver? Why not just sit on the sidelines and preserve what you have? That's the reason you see our returns are so much higher. You avoid the declines. This tool is absolutely vital and essential for anyone who has a retirement plan with their employer, or even if they have their own self-directed plan with a discount broker. Okay, now that we're talking about discount broker, let's talk about the benefits to those people. We can go up here now and we can just do, since you have a discount brokerage account, you can buy anything, okay? Let's just rank this, eliminate the fidelity here, and let's just rank these by performance. So now you just hit CAGR and do submit, okay? And now you're going to see here, you've got assets that grow better than 200% a year you could be investing in. The problem with these assets is if you look over under the S&P correlation, is that they're not very correlated. So let's go find the highest on this one single page here just to see it's pretty correlated. Okay, well here's one, 0.866. Look, anything above 80% correlation is good to own, okay, and follow the signals. At 86% correlation, you could have done 53% buy and hold. Now, using our signals, you could have done 56.67, only 3% more. Wow, just 3%. If you take 3% over 15 years, 20 years, the difference is substantial. So you can quickly see here that by ranking these, and you can still find securities that are in the 50% per year growth rate and have high correlation, okay? Now, there's one more thing I do want to show you. I'm going to shut the correlation filter off here, and I'm going to go to the sector area. You can find any security you want in any sector or area of the world, okay? Anything. And you can rank them as well. Now, there's one thing I do want to get to here, and that is bear market. You can actually rank the securities bear market. In other words, you remember negative correlation? You can find them by ranking and just hitting submit. It'll tell you which ones are better than 80% correlated to the inverse of the S&P. It's all here within the Wealth Maximizer. Let's go back now, take a look at the charts, and see the comparison and the performance differences. I promised you some fun. Now let's get to it. Our comparative analysis. Now that we understand correlation and how it works with our wealth preserver arrows, let's take a look at 4 different investor personalities. And you can determine which one you are from this example. John, okay? John doesn't own the wealth preserver. He doesn't even know anything about it. He's just basically a Standard & Poor's index investor. And obviously with the SPY correlating 99.99%, his growth rate is also going to be just like the S&P. He's going to buy and hold and just go. Mary, on the other hand, is going to own the wealth preserver and subscribe. And when she does get a green arrow, she's going to invest in the SPY. So it's identical to John, okay, except that she does get out when she does get red arrows. Her correlation is identical when she's invested. It's 99.99%, okay, to the S&P. And her growth rate when she is invested matches the S&P. Noah, on the other hand, okay, he is also a wealth preserver, except he likes a little bit higher growth. He will buy RYNVX, okay? And RYNVX correlates 99.18%. It's almost identical to the SPY, except it grows at 150%, or 50% more than the S&P when the S&P goes up. Now let's talk about the final investor, and that's Leah. Leah is also an owner of the wealth preserver, except she likes a little bit more growth than Noah. So even though she buys RYTNX, we know that RYTNX has 96.39% correlation. It's still going to grow exactly when the S&P 500 grows, except Leah will get 200%. Okay, so in other words, she will grow at 100% faster than the S&P 500. So let's now take a look at the charts. John is a traditional buy and hold investor who loves to pay someone else to manage his money, but has not learned about correlation and its benefits. So when he invested $100,000 on January of 2000, he would have done buy and hold, and his $100,000 would have grown to $179,000 as you see in the chart. Mary is more or less like John, except she understands correlation, owns the wealth preserver, and follows the red and green arrows. At the end of the same time frame, she ended up with 487% greater profit than John. Noah is more or less like Mary, except he understands correlation very well and appreciates a fund that grows 50% faster than its own index. His performance is substantially better than that of John's buy and hold. Leah is more or less like Noah, except she understands correlation extremely well and loves the fact that her money can grow 100% faster than the index it is correlated to. She understands correlation. Okay, let's continue with our comparative analysis. Look, all of them started with the same 100,000 on January 1, 2000. Only you can determine which person you want to emulate. But you must understand that Mary, Noah, and Leah follow the exact same arrows. And the growth rate has no effect on the correlation. So looking at the table below, okay, you can see that the ending values are substantially different. John did the buy and hold, ended up from 100,000 to 179,000. Mary ended up with 458,000. Noah ended up with 637,000, and Leah ended up with almost $1 million at 825,000, with the exact same correlation. So, who do you want to be like? You now are already ahead of John because you know and understand what correlation is, how it works, and how it benefits you. Once you submit your low tax-deductible subscription, you can determine precisely which investor you are and then have fun. Here are some final thoughts. You've heard the saying that knowledge is power. Well, so is correlation. Correlation is power. Aldous Huxley is one of my favorite brilliant minds of all time, and his quote is perfect for you to think about. Facts do not cease to exist just because they're ignored.